Calculate and interpret the present value of fixed income and equity instruments based on expected future cash flows. So we're going to look at a series of cash flows related to fixed income security and a series of cash flows in a very naive way. We're only going to look at cash flows in terms of dividends, but a series of cash flows based on equities, which are common stock. So let's begin with 3 rules of money, and you may have heard these in another context. Rule number 1, larger cash flows are worth more. I don't think I need to expand on that. Less risky cash flows are worth more. You would use a lower discount rate on those future cash flows. Good example, let's take 2 identical sets of cash flows from a bond. Same coupon, same future value, except one's a corporate bond, one is a government bond. You would expect to pay more for the government bond. The cash flows are less risky. You're more certain to get them, so you would discount those future cash flows at a lower discount rate. And cash flows sooner are worth more. That is the time value of money. What complicates our assessment of what type of investment we would like is the mix between the time until we get the cash flow and the riskiness of that cash flow. So have a look at this timeline. And just by looking at it, can you tell me which one is the better one? We have an early cash flow here at time 1. Well, sooner cash flows are worth more, but it's risky. If we wait till time 2, we can take this investment. It's a nice safe one. Less risky cash flows are worth more. However, we have to wait 2 years to get our money instead of 1 year. And if we wait to year 3, we get a larger cash flow. There's our larger cash flow, but it is risky and it does take more time. Which one is the better investment to take? Well, we're going to have a different discount rate depending on how long we have to wait to get our money. The longer we have to wait, there is going to be, you'll recall from the previous reading, some maturity premium associated with it. Well, some of these cash flows are risky. Because they're risky, they will have some sort of default risk associated with them, so we'll use a higher cash flow. Whereas the safe one really just contains the 2 premiums we have here, the risk-free rate and the expected inflation rate. So we're going to have some way that we can compare all of these, and we compare them based on present value. We find a discount rate that's appropriate to each of those cash flows. We discount them. We look at the present value. Which one is the larger in terms of present value? That means it's worth the most for us today. That requires discounting at a rate that depends on the timing and the type of cash flow. And you recall from the previous reading, we introduced the components of the required return. We have our default risk-free component plus our expected inflation. If we go into corporate bonds, we have a default premium. If we are dealing with private debt, you have a liquidity premium. And the longer you lend money for, you have a maturity premium. We're also going to introduce an equity premium because equity is riskier than debt. In the capital structure, debt sits above equity. What does that mean? That means if the company has to liquidate, all the debt holders get paid first. Anything that's left over goes to equity. They have first priority on the assets. So because equity has to wait in line after debt, no matter how risky your debt is in the capital structure, equity will always be riskier than the riskiest debt. So there'll have to be some premium on our required return to compensate us for being in equity over debt. We should be comfortable with the notions of future value and present value. And to calculate a future value, we take the current amount of money or investment we have and we compound it into the future. To arrive at a present value, if we know our future value, we discount the future back to the present. Going forward, we compound. Coming backwards, we discount. If you this formulation to the negative t, it's the same as what I've shown over here. 1 over 1 plus r to the t is the same as 1 plus r to the negative t. And if we're using continuous compounding, we can calculate our future value by compounding the present value, or we can find our present value by discounting the future value. Notice the difference here. It's e to the negative rt, which is the same as 1 over e to the rt. That is for discounting a single cash flow. When we get to our fixed income securities, especially when we get to our coupon bonds, we have multiple cash flows. So I'll show you how to get that done. For discounting a single cash flow, zero coupon bonds. These are discount bonds. These are bonds sold at a discount. You pay one price and they simply mature at their face value. There is a single cash flow at maturity. This is all we need to get it done, what I've got at the top of the screen here. So fixed income, these are debt instruments, bonds, loans, mortgages, etc. There's a whole section on fixed income at level 1, and you'll be with it at level 2, and yes, you will see fixed income at level 3, but in a portfolio management context. A zero coupon bond, these are T-bills, so if you see a 1 month or a 3 month or a 6 month, up to 1 year, these are T-bills. These are called money market securities. They're simply sold at a discount and they mature at par. So up to 1 year maturity on the T-bills. That doesn't mean that zero coupon bonds are only up to 1 year. There are something called stripped bonds where a dealer will buy a very large bond and strip out all of the cash flows and sell each of those cash flows as a zero coupon bond. So it is possible to buy a 10-year zero coupon bond. You've got all that wonderful stuff to look forward to in fixed income. They are sold at a discount. They mature at par. There is a single cash flow at maturity only. That's the big thing you need to know about zero coupon bonds is you're dealing with a single cash flow. When you're dealing with coupon bonds, these are in treasury terms called notes or bonds. Notes are the 2-year up to the 10-year, and bonds are anything longer than the 10-year. The investor receives a number of interest payments over time and par at maturity. So think about that. Let's do a 2-year bond with semi-annual payments. You'll get a coupon, and your last payment will be coupon plus principal. Well, you have to discount this cash flow, then you have to discount this cash flow, then this cash flow, then this cash flow. Notice you have a different time for each cash flow. When you get to the fixed income section, you will learn that we discount each cash flow with its own particular spot rate, but that there is a faster way to do it if we already know the bond's yield to maturity. We'll see that shortly. Throughout this particular reading, I will be referring ahead to things that you will see in other sections. So there is much of this reading that if you didn't do this reading, you would see everything in future sections. So if you have been through other sections and here you are now, you may be saying, this is all repeat. I know all this stuff. Yes, you do. I advise everybody to start with quant because it's the basis of everything. So what you're seeing here, you will see in other places. So if you feel that, wait, I don't quite understand that, don't worry. We're just introducing the arithmetic behind some of these things. The conceptual ideas are not that important. You're going to see them later. The question would be then, if I skip this reading, would I lose anything? No, you wouldn't, because you're going to see each and every single thing we talk about in a future reading. It's one of these beautiful readings that if you skipped, you're not going to lose anything. However, when you get to those future sections, it would be nice if you had already been through this because you say, okay, I'm halfway there. I remember most of this. Fully amortizing bonds. This is your mortgage or your auto loan. Basically, every payment you make is interest plus principal, so that the last payment you make is interest plus principal. Notice up here, coupon, and one big payment. That's called a bullet bond. One big payment at the end, all your money back. Whereas with a mortgage, the lender gets a little bit of principal back with every payment, and when you make the last payment, the balance owing is zero. The investor receives level payments of both interest and principal. Okay, let's take this bicycle for a spin here. Let's work with the zero coupon bond, and we'll work through 5 pretty straightforward problems. Each orange dot here represents a problem statement where we're given some information and asked for something. We're dealing with zero coupon bonds, which is a single cash flow. Remember, our present value is our future value. Discounted for the amount of time that it is in the future. R is the discount rate, also known as the internal rate of return or the yield to maturity. So let's start here with a 20-year zero coupon bond. Yield to maturity is 6.7%. What is the present value? Well, our future value is 100. This is a simplification we use for all bonds. We use what's called the 100-point system so that we don't have to worry about the face value of the bond. Is it a $2,000 bond, $10,000 bond? we use $100 so that we come up with the price of a bond per 100 of par. We'll always use the 100-point system. So if you're not given a future value for a bond, it's always 100. So the future value is 100. Our discount rate is 6.7% for 20 years. We get 27.33453. And you can calculate it that directly. Or you can use the time value of money keys on your calculator. Type in 100, then hit FV. Type in 6.7, hit your interest rate factor, and you must put this in as a percent. Do not put in 0.067, 6.7. So if the discount rate's 5%, you enter 5, not 0.05. Your payment is 0. You're gonna have to put that in because the time value of money keys have a memory. And if you used it to calculate the price of a coupon bond, and there's the number 2 in there, or let's say $20 is in there, and you don't put 0 into PMT, the time value money keys will remember the last number you put in there. So you must put in 0 and not just say, oh, well, it's 0, I don't have to put it in. You must tell your calculator it's 0 or it will use the last value you entered in there, okay? Your N is 20, compute PV. Next one, 3 years later, what is the price if the yield to maturity is unchanged? Well, we can do this in one of two ways. We have now the present value. We know what the future value is, so we can take the future value and discount it for only 17 years instead, or we can take the present value and compound it for 3. So I do both for you. Future value in 3 years is our present value compounded for 3 years. We get 33.205. If you calculate the present value as of year 3, it's our future value discounted for only 17 years. You come to the same answer, 33.205, and I give you the time value of money keys to get that done. Notice on PV, it must enter as a negative number because time value of money only works when you have cash flows out and cash flows in to determine what that internal rate of return is. If all the cash flows are going out, you cannot calculate an internal rate of return. So typically your present value is an outflow because that's the money that has to leave your pocket to buy the bond. So that money is leaving you and all the coupons and future value are coming in, so they're positive cash flows, right? Make sure that you put a negative sign in front of that PV or you're not going to get an answer. Okay, let's say that instead of the 27.33, we observe the price of the bond at 22.68224. What is the yield to maturity? Now here we know everything except for the R. So we got to solve for the R. A little bit of algebraic manipulation gets us to this statement here where we can solve for R. How you do this is you cross multiply 1 plus R to the 20 on both sides. Then you divide through by 22.68 and you'll get this. Take the 20th root of both sides to get rid of the power term here. You'll have 1 over 20, then subtract out the 1. There's your R. If you're using time value of money keys, there you go. And notice right there, you've got the negative sign in front of PV. Don't mess up on that, right? Compute your interest rate factor, 7.7%. All right, let's head over to Japan. Let's get some negative yielding debt here. Interest rate here, negative 0.05%. Notice it's already in percent. That is in decimal form, negative 0.0005 in decimal form, but for your calculator, it's negative 0.05. And if you are putting it into your calculator for time value of money keys, you must use the negative sign. You have to use the negative sign, as I show you over here, okay? It's a 10-year zero coupon bond. What's the price? Well, we already know how to do that. Notice our denominator is 1 plus R. Well, it's 1 plus a negative, so you're going to end up with something less than 1. Whenever your denominator is something less than 1, you will have a present value that's greater than the future value. And here are your time value of money keys to get that done. And finally, the last one. 6 years later, you see a price of 95.72. What is the yield to maturity? Well, we could just take the, as I showed you in the second example, you could take the present value and compound it forward for 3 years, or you could just take use this formula. Since we have the present value, we have the future value, and just solve for R, which is what we do here, 1.09957. Your time value money keys at the very bottom, notice the negative sign on the PV. I'll continue to point that out so that it is drilled into your head so you don't forget it. Okay, let's move on to coupon bonds. Coupon bonds have a form that looks like this. We calculate the present value by discounting each payment, and our last payment we received, the last cash flow, will be our payment. Our payment is our coupon, plus the future value of the bond, whatever the face value happens to be. In fixed income, you will learn that to get to the PV, you will discount each payment by its own particular spot rate. Once we have a present value, we can then use that to calculate what the yield to maturity is, which is a value that we could use. It's kind of like a weighted average discount rate. It is a single rate that we can use for all cash flows. I don't want to confuse you now by thinking that's the way it's done. That's just an easy way to do it. When you get to fixed income, you will learn that each cash flow is discounted by its own spot rate, because this is treated as a zero coupon bond. This is treated as a zero coupon bond. This is treated as a zero coupon bond. The sum of all these zero coupon bonds totals the present value of your coupon bond. Isn't that nice? Okay, the time value of money keys are up here. For multiple cash flows, we have to be aware of a little issue. Sometimes these bonds will pay their coupons annually, sometimes semi-annually, sometimes quarterly. When they pay semi-annually, a 10-year bond has 20 payments, so our N will be years times the number of periods. That means the coupon we receive will be the coupon divided by the number of periods. So if we have a 5% bond that pays $5 a year on 100, pays $5 a year semi-annually, that means we get 2.5 every 6 months, every period. So we just have to adjust everything for the periodicity. I'll show you how to do that here. Let's say that we have a 7-year, our first example here, 7-year, 2% annual bond issued at a yield to maturity of 2%. So we're already told what the yield to maturity is. One thing I'm going to point out here, the coupon is 2%, the yield to maturity is 2%. When the coupon and the yield to maturity are the same, you will get a par bond. A par bond, meaning that the present value equals the future value. So if the future value is 100, the present value will be 100 if the coupon equals the discount rate being the yield to maturity. You can, satisfy yourself. Put in a future value of 100, put in a payment of 2. 2, why? It's annual, right? Your discount rate is 2, your N is 7 because it's 7-year bond. Compute the present value, you should get 100. That is called a par bond. 1 year later, we observe a price on this 7-year bond, 1 year later at 93.091. What is the yield to maturity? Now, as you're going through the examples in the CFA reading, it is quite common to come across mistakes, unfortunately. So as you're going through this example and you look at the answer, you say, how come we're not getting the same answer? Is because even though they say 1 year later, we can clearly see we had a 7-year bond. 1 year later is a 6-year bond. They use 5. That's why you're not getting the right answer. So 1 year later, we see a price of 93.091. What is the yield to maturity? Well, use our time value of money keys. We know the future value. We know N is 6 now. We know our payment is still 2, and we now are given the PV, so we enter that. What do you see in front of that? A negative sign. Then you compute your interest rate factor, and you will get your yield to maturity. Annual. So we didn't have to do very much. Let's mix it up. Let's go to semi-annual. 20-year, 6.7% semi. Usually if it's a semi-annual bond, it'll just be called a semi. It won't be written out semi-annual bond. It'll be called a semi, or it'll be called a quarterly. So if you read something that says it's a 6.7% semi, that means it's semi-annual payment. 6.7 semi, that's your coupon, issued at a yield to maturity of 6.7%. Calculate the price. You don't have to. As soon as you see that the coupon and the yield to maturity are the same, you could just say it's a par bond, it's 100. Well, what if the yield to maturity were 7.7% instead? So it pays a 6.7% coupon, but the yield to maturity is 7.7. Here's a relationship. that you'll find. If the yield to maturity is higher than the coupon, you will have a discount bond, meaning the present value is lower than the future value. It would have to be, because if the coupon gives you 6.7%, how are you going to get the extra 1% to get to 7.7? You're going to have to buy it at a cheaper price. And if the yield to maturity were lower than 6.7, it means you're getting paid too much on the coupon, you would have a premium bond. 7.7%. We can use our time value money keys. Look what we got to do here. Let me get a color that jumps out at the screen at you. Future value, 100. Our N, it's a 20-year bond. It's a semi. So N means the number of periods of cash flows. N is not the number of years. It's how many cash flows. Your calculator is saying, how many cash flows do you want me to deal with here? 40 cash flows. Because there are 40 payments. It's 20-year bond, semi-annual, so you got 40 payments. What is each payment? Well, if the coupon is 6.7, it's paid semi-annually, it's 3.35. What's the discount factor? You must do the same for the discount factor. Divided by 2, 3.85. If you mess up, you'll get garbage out of your calculator and you'll be wrong. You must tell the time value of money keys exactly what the cash flows are. We have 40 cash flows, not 20. Each cash flow is 335, not 670. Each period's discount rate is half the yield to maturity because it's semi-annual. There's your present value, 89.8788. It is a discount bond. It's selling for less than par. As soon as you know it's a discount bond, you say to yourself, the market wants a higher discount rate than what the bond's coupon happens to be. What if it's a 20-year zero coupon bond? We're going back to the zero coupon bond, assuming a yield to maturity of 6.7% compounded semi-annually. On the previous screen, we just looked at the present value of that 20-year zero coupon bond and we discounted it annually. Well, what if it's semi-annual? Well, you could take the 100 and you could discount it at 1.03, 1.035? 1.0335 to the 40. Or use your time value money keys. Your future value is 100. You have 40 compounding periods, but no payment during those periods. Your interest rate factor is 3.35%. Compute PV 26.7658. All right, next up, let's price out a perpetuity. A perpetuity is a security that pays you a coupon forever. You buy the security once and it just continues to pay a certain yield forever. So some bonds are perpetual bonds, and more often you'll find it with preferred shares. They're called perpetual preferred shares. And how do we determine the price of a cash flow that goes on and on and on and on and on with no end? It simplifies to this. Present value equals the payment you received divided by R. That's it. That's your yield to maturity. So let's say that we can buy a security that has a 3.3% quarterly coupon, and we're still going to use the 100-point system. We see the price of 97.03, and we want to know what the discount rate is on that. So in other words, we're solving for R, the denominator here. What's our yield to maturity if we pay 97.03 for a security that'll give us $3.30 a year? Quarterly, it gives us 82.5 cents quarterly forever. Well, we have to put it in the right terms. Since this is 3.3% quarterly, our payment is going to be 3.3 or $3.30 divided by 4, 82.5. That means we'll be solving for a quarterly yield to maturity. So the yield to maturity we get is on a quarterly basis. You must multiply it by 4 to bring it into an annual basis. Now, here is a quick sanity check on your math. 97.03. This is a discount to 100. You have a 3.3% quarterly coupon, which means the yield to maturity must be higher than the 3.3 to create a discount bond. You get 3.401. You could do a quick check. Is that higher than 3.3 because this is a discount? If it is, I probably hit the numbers correctly. All right, let's move over to annuities, which are mortgages and car loans, and you're given this formulation, A equals, and R times PV. That's the interest rate that you would pay divided by 1 minus 1 plus r to the negative t. Honestly, I've never, ever used that. You don't have to. I don't see the value in that formula. I think you can safely ignore it. We're going to just use the time value of money keys on your calculator. So let's say that we have an $800,000 30-year FRM. FRM means fixed rate mortgage. One of the most popular mortgages in the US is the 30-year fixed rate mortgage. Almost all mortgages in the US are issued as 30-year fixed rate mortgages. In other countries, the more popular mortgages are like 5-year floating rate or five-year fixed, but very rarely 30-year. This is a big US thing. 30-year fixed rate mortgage at 5.25%. What would be your monthly payment on this mortgage? Okay, well, mortgages are done monthly, so we got to do a little bit of acrobatics here with our time value of money keys. What is our N? How many payments are we going to make? It's a 30-year mortgage, and if we're paying monthly, we make 360 payments. Your N has to be 360 because we're calculating how much our monthly payment will be. Our future value will be 0 in this case. Why? Because these are fully amortizing securities that once you make that last payment of interest and principal, the balance owing is 0. The future value will be 0. Your present value, negative 800,000, and your interest rate factor that you're putting in, since the mortgage is at 5.25, you must divide it by 12 for monthly, 0.4375, compute your payment, $4,417.63. You'll see this in fixed income. This is an amortization table because there is a whole reading on mortgage-backed securities. These are bonds backed by mortgages. So let's just let's amortize the first 2 months of this mortgage so you can see how the principal and interest works. Our first month payment is going to be based on a principal amount of $800,000. So we're going to have a payment of $44,1763. There's month 1 payment. The interest that we pay is $3,500. How did we get to $3,500? Well, notice our interest rate factor here for the month is 0.4375. Multiply 0.004375 by 800,000, and you will get 3,500 because you're paying interest on the outstanding balance. Well, if your payment is 4417, your interest is 3,500, the principal must be the difference, 917.63, which means at the end of the month, your principal is now 799.082. The next month, you pay the same amount. It's principal and interest. But look what happens to your interest. It drops. It is your balance, B, your balance multiplied by R over 12, the 5.25 divided by 12, which is the 0.4375. And you'll get 34.95.99, but since you paid the same amount, the amount that you pay towards principal increases. This is the payment you make minus the interest. And this is now your new balance. So you're going to take the balance at the beginning of the year, which is 799.08237, subtract the principal component that you paid, the 921, to get to your balance at the end of the second payment. And then that would continue on for 360 rows in a spreadsheet. You can do it yourself. You can program, the rows of each cell in a row. You can put the programming in, and then with Excel, you hover over the bottom corner, there's a little square, and you could just drag down, highlight all of these and drag down, and the whole amortization table will fill in for you. Okay, enough with fixed income for now. Let's move on to equity. And equity is either preferred shares or common shares. They're both equity, but we'll focus on just common shares right now. And the cash flow that we're going to be concerned about is a dividend. Some stocks don't pay a dividend. That doesn't mean you can't use a different measure of cash flow, which could be earnings, it could be free cash flow. You'll see all of that at level 2 equity. But for now, we're just going to assume that we're discounting dividends. So we can have a security that has a constant dividend. Every month it's the same dividend and it just goes on and on. Well, because common stock has no maturity date, that's a perpetuity. What if the dividend grows over time? Since it still has no maturity date, we still have a perpetuity, but we have something called a growing perpetuity, which is just a small adjustment to the perpetuity formula. If we have a growing dividend, but at a non-constant rate, then we're going to have to break it out into some explicit forecasting period, followed by some future value that is the present value of a growing perpetuity, and then discount back that value. Sounds complicated, right? It's kind of easy. I'll show you at the bottom of the screen here. So for a constant dividend, many REITs follow this pattern where the dividend doesn't change for years and years at a time, where you get the same dividend every single month. That is basically a perpetuity. Present value is the dividend divided by the discount rate. So let's say a REIT pays $1.50 a year, and the required return on equity is 15%. You should be paying $10 for that. Let's look at a constant growth dividend. This is very typical of commercial real estate. Now, the REIT is an organization that owns commercial real estate, but sometimes you have to price out the property value of a particular building, or maybe you're invested in an apartment building or a strip mall, and you want to know what the property value is. But in your rents, you have an increase in rent every year. Well, that is a growing dividend, right? So this is typically used to price out commercial real estate to calculate property value. The present value is next year's dividend, D naught, whatever dividend we have, 1 plus G. You'll calculate what next year's dividend is, and you'll divide it by R minus G. So look at the difference between D and R up here. Our D is, this is the current dividend we get. For the growing perpetuity, it is next year's dividend that we get. We increase it by the growth rate. Instead of dividing it by R, we divide it by R minus G. For commercial real estate, to calculate property value, we don't use a dividend. Our numerator is something called net operating income, because if you own the property, the net operating income basically is your dividend. And we divide by R minus G, and in real estate, R minus G is called the cap rate. You'll see all of that coming up in the CFA curriculum. A variable growth dividend. Think about a growth stock that is currently a growth stock now that will then eventually move to a value stock. So it may have a dividend that's growing at a certain rate right now, but at some point in the future, that rate of growth is going to slow down. We would use a two-stage model. The first model is what we saw when we looked at coupon bonds for fixed income. We had a number of payments, each discounted over a period of time. That's called an explicit forecast period or an explicit discount period. Let's say it's 3 years. You would calculate the dividend for each of the next 3 and discount it by 1 plus R. It's just a straight discount at that point. You're just discounting a dividend. And then you have some terminal value. Well, that is your growing perpetuity up here. Look at this part up here. This is your growing perpetuity. Now, the numerator may cause you some grief saying, well, what's going on up here? G sub S means the short-term growth rate. G sub L is the long-term growth rate, which tends to be the lower growth rate. So this is the dividend today. 1 plus G S to the end is what the dividend will be at the end of the explicit forecast period. And then remember, the numerator is D naught 1 plus G. Well, D naught in the future is all of this. And then 1 plus G, and then it's R minus G. And let's be clear, the G we're going to use down here is GL. Well, that is the terminal value at some future point. We must discount that terminal value back to this present value. And yes, we do have some examples coming up so you can see them in numbers. Okay, let's take a dividend of $1.50 D naught. That is the most recent dividend. It's going to grow at 6%, and we have a required return on equity of 15%. This is a growing perpetuity, which is very typical of value stocks. We want to calculate a present value. It is D naught 1 plus G. D naught is 150. 1 plus G, G is 6%, times 1.06 will give us $1.59. That is our next dividend that we get. Divided by R minus G, 0.15 minus 0.06, that's 0.09, $17.67. Let us complicate this a little bit. Let's assume that that 6% is only going to last for the next 3 years. The dividend's going to grow at 6% for the next 3 years. S means short term, not the slow growth rate. It's short term. And then in the longer term, our growth rate will drop to 2% thereafter. What is the present value? And here with numbers, it becomes a little bit more clear what I was showing on the previous screen. Our first dividend is 150 times 1.06, discounted at 1.15. Our next dividend will be 150, 1.06 squared, because it is this dividend grown by 6%, and the next dividend will be this dividend grown by 6%, so we just keep increasing the power term. It's the same thing, discounted by 1.15. Then we calculate at the beginning, this by the way over here would be PV3, because we're 3 years later, right? And we're calculating the present value of all the rest of the cash flow. So if you look at it on a timeline, we got a dividend here, we got a dividend here, we got a dividend here. The next dividend will be over here, but we want to know what the value of all these other future dividends are from this point onwards. Well, we're over here. We take the present value of all of these. That's a growing perpetuity. Well, if we're over here, we still got to get the present value of that terminal value back, right? So what is our dividend at this point in time? It's going to be the 150, 1.06 to the 3, which was the dividend in the previous period, grown by 2%. We divide that by the cap rate, 0.15 minus 0.02, R minus G. That'll give us the price of the growing perpetuity at this point in time. Now we have to discount it back to here. That's why it's discounted at 1.15 to the power of 3. So the first term is 1.38, next term 1.27, next term 1.17. The perpetuity, this stock here in 3 years will be $14.0174. But what is it today? We discount it back to today. We get a price of $13.04833. Our next learning objective, calculate and interpret the implied return of fixed income instruments and required return and implied growth of equity instruments given the present value and cash flows. Let's say I tell you that I bought a stock for $67 and 2 years later I sold it for $132. Not bad, huh? And then you say, well, what is your implied return? What does that result in if you were going to tell me what return that you made? And remember, all rates are quoted annually. The easiest way to do this, it's so simple, is you take your ending value divided by your beginning value, and you put 1 over, how long did you hold it for? 2 years minus 1. That's it. Ending value over beginning value. Take whatever root you have to annualize it, minus 1. To see it, remember, the PV is our future value, discount about 1 plus r to the t. Cross multiply by 1 plus r to the t, you end up with this first line. If we divide through by PV, you end up with future value over present value. If you get rid of the t over here, we can get rid of it there, you'll get 1 over t over here. Get rid of the 1 over here, there's the 1. The future value over the beginning value, take a root that annualizes it, subtract 1, and there you go. So, let's give this a go. Here's that zero coupon bond we dealt with before. It had a present value of 100.5. We had calculated the value at year 6 at 95.72, and we know it matures at 100. So let's say that we sold it to somebody after 6 years for 95.72. What is our implied return? And for the person buying it, what is their yield to maturity going to be? And it's really easy. Ending value over beginning value. So our ending value is 95.72, beginning value is 100.5, to the power of 1 over 6. 6 years minus 1, negative 0.8088%. For the next one, ending value 100, beginning value 9572. How many years for? Power of 1 over 4 minus 1, 1.1%. Couldn't be easier, right? With coupon bonds, it's a little bit more difficult because we have to worry about the reinvestment of cash flow. So let's take a coupon bond, a 2% coupon bond. We paid $100 for it. We got a $2 coupon at the end of 1 year. We got a $2 coupon at the end of 2 years. And at the end of 2 years, we sold it for 93.091. What was our implied return? Well, here we have to calculate what the future value of everything is. What is our ending value over here? This 93,031, that's just the price. Remember, we got this $2 over here and this $2 over here. So the first $2, we assume that we can reinvest at the yield to maturity rate. So that $2 will be invested for 1 year at 1.02. The next $2 happens at the same time that we sell the bond, so it doesn't have time to grow, plus we sold the bond for 93,091. So the future value of our portfolio, if we have a portfolio with a coupon paying bond in it, and we get a coupon and we reinvest it, and then we liquidate everything at the end of 2 years, would have 97.131. We have to first calculate our future value when we have multiple series of cash flows, because we have an assumption that we reinvest those cash flows in our portfolio. Ending value over beginning value to the power of 1 over 2 years, 1 over 2 minus 1, negative 1.445% pre-tax, of course, right? Okay, so we've seen how to calculate the implied return from a fixed income security given an ending price, a beginning price, and a period of time. We can also calculate the implied yield to maturity. Let's move over to equity. For equity, we have two variables. We have a required return and a growth rate, because we can always observe a price and we can always observe a dividend. We have to estimate the other two. So from our original formulation for the present value of a growing perpetuity, we had D naught multiplied by 1 plus G over R minus G. Let's multiply both sides by R minus G and get to our first line over here. Divide through by PV to isolate R minus G, and then isolate R by adding G to both sides. Here you go. R equals this D naught 1 plus G is really D1. It's the dividend that we expect over the next 12 months divided by price. That's a dividend yield. And G is just your growth rate. This formulation you'll see later in the equity section is the basis of the Gordon growth model. Well, we have a G over here. If we subtract the dividend yield from both sides, we'll get R minus the dividend yield if we want to calculate what the implied growth rate is given all the other variables. So let's say we observe a stock selling at $63. The next year's dividend is going to be $1.76, and our growth rate is 4%. Be careful here. I'm giving you D1. It is quite common in questions to either give you D naught or D1. You have to pay attention to that. If you're given D naught, you must grow it by the 4%, whatever G is, you must grow by the 4% to get D1. If you're given D1, it'd be common for me to ask you a question, give you a price, give you D1, and give you a growth rate, and let you walk into the trap of increasing D1 by 1.04. Be careful about that. So it's our dividend yield plus our growth rate. 1.76 over 63 plus 4% gives us 6.79%. Well, what if R were 7%? What does that say about the implied growth rate? Well, we just use this term over here. We take our required return, 7%, minus the dividend yield. That makes sense, right? What do we require? 7%. Well, what are we going to get from the dividend? A certain percentage. That means growth has to be how much? 4.21%. If we take our present value of our growing perpetuity and we divide both sides by E, E being earnings, on this side we have PV, which is the price, divided by earnings, you'll get PV over E, which is a PE ratio. If you take the other side and divide by E, you'll get, after some simplification, this over here, D naught over E. Well, that's dividends divided by earnings. That tells us the proportion of our earnings that were paid out in dividends. That's a dividend payout ratio. So PE ratio equals the dividend payout ratio, 1 plus G divided by R minus G. So if we observe a PE on a stock and we know the dividend payout ratio, we can solve for R or G given the other. This is useful when we can observe some fundamental values of a stock and say, well, what is the price saying about the required return? What is the price saying about growth, so that we can determine whether or not the market's implied growth rate equals our estimated growth rate. So we can compare the implied R or G to the required R or expected or estimated growth rate. A more common use of the PE is something called a forward PE, because when you buy stock, you buy the future. So we want to estimate what the forward earnings multiple is. If you have a stock that has increasing earnings and you calculate a PE, you can use the trailing earnings, the last 4 quarters of earnings, or you can use the estimated next 4 quarter of earnings. If you use the previous 4 quarters, you end up with something called a trailing PE. If you use the next 4 quarters, you end up with something called a forward PE. For a growing stock, the forward PE will be lower than the trailing PE because the price will reflect the future, not the past, and the future will have higher earnings. So whenever we're looking at stock indexes or the value of any stock, it is more suitable to look at the forward PE because you're buying the future, not the past. So it doesn't matter what the historical PE was, you're interested in the forward PE. So we can use a forward PE in what we've done on the previous screen. PV divided by E, T plus 1. There are your earnings in the next period. So that is a forward multiple. How does the other side change? Well, we're going to have to use a forward dividend. Remember, we had D naught 1 plus G, and then we divided that by we divided that by E, earnings. Well, if we're using a forward dividend, we get D1, right? Well, that gets rid of all of that. That's why we have this DT plus 1 is D1. DT is now, DT plus 1 is 1 period out. So it just gets rid of the whole thing. So it simplifies to just a forward dividend payout ratio. So a forward multiple equals the forward dividend payout ratio divided by R minus G. Now we can say a lot about this. Let me just draw a border around here to draw your eyes to it, because this is really important. If we observe the S&P 500 trading at a particular multiple, let's say it's trading at 17, and we're wondering whether or not it would be worth committing more money to the market at this point, it would be if we expect the market to start trading at higher and higher multiples. Well, what can get a market to go from 17 times earnings to 20 times earnings? That would be a great market to be in. You want to be in a market where earnings are growing and the multiple is expanding at the same time. That is a market that goes straight up. Well, if we look at this side of the equation, we can see if the forward dividend is expected to increase up here, or if G is expected to increase, the stock or the index will trade at a higher forward multiple. So let's say we observe the S&P 500 trading at a forward multiple of 17 times, but that we expect the economy to move from 1% real GDP growth to 4% real GDP growth. That means earnings, the growth rate for earnings for all companies will increase. And since we're looking at a stock index, we tend to look at the growth rate of the economy, not a particular company. If we expect higher GDP growth in the future, that means higher earnings. And if you keep the same dividend payout ratio, your dividends will increase as well. So whenever we're expecting that, we would then commit more money to the market, because not only are we going to get higher prices because of higher earnings, but higher prices because of higher multiples of those higher earnings. So the forward PE is a very valuable tool. Higher required return leads to a lower multiple, because it is right here. The higher this is, the larger the denominator. The larger the denominator, the lower the multiple would be over here. We can see that over 2022 with interest rates rising. As the risk-free rate rises, we also saw expected inflation increasing over previous years. So that rises, and you have to add all those premiums on. Remember, the equity risk premium is added on after all of that stuff is added on. So if those base components are increasing, the required return will increase. We saw the market from the beginning of 2022 trade at roughly about 20 to 21 times forward earnings. At the low point in 2022, traded all the way down to just below 17 times earnings as interest rates went up. So let's play around with this. Example 1 here, we observe a stock with a forward PE of 28, expected dividend payout ratio of 70%. We've observed over history that the growth rate in earnings of the company is 4%. What is the required return? And it's really nice and simple. It is your expected dividend payout ratio divided by R minus G. R is the one we have to solve. We know our PE is 28. Well, this is just algebra, and I show you each step here of how you get to 6.5, how you isolate R to get to 6.5. Forward PE of 19, expected dividend payout ratio 60%. This time we have the required return that we expect from the stock. What is the fundamentals, the PE and the payout ratio, saying about the growth rate? Well, we just solve for G. It is our dividend payout ratio divided by R minus G. We know that has to equal 19. G is 4.84. Here is a more common way that you would use this. We observe a stock with a forward PE of 28. The expected dividend payout ratio is 70%. Required return on the stock is 9%. And we have a growth rate of 4.5%. Should we buy the stock? It's currently trading at 28 times forward earnings. Should we buy it? Based on fundamentals, should we buy this stock? Well, let's calculate a PE. What should the PE be based on the dividend payout ratio, the expected return, and the growth rate? It should be 15.5 times earnings. The market's trading it at 28 times earnings. That is way too expensive. So we wouldn't be interested in buying that. If we owned it, we would say this is a good time to sell this stock. It's extremely overvalued. And if we were really bold, we would say this is a short candidate and we should short this stock. So it should be trading at 15.5 times forward earnings, not 28. Therefore, this is a sell. Next learning objective, the keyword explain. Notice we have no calculate and interpret here. Explain the cash flow additivity principle, its importance for the no arbitrage condition, and its use in calculating implied forward interest rates. There's one thing we have to do. Forward exchange rates, there's the second thing we have to do. And option values, there is the third thing we have to do. Okay, this is an LOS that can be skipped entirely. Not because it's not important, it's because everything in here you're going to see later on. Implied forward rates, you're going to see in the fixed income section. Forward exchange rates, you're going to see in the economics section. Option values, you're going to see in the derivative section. With everything explained from the bottom up, which is what I'll attempt to do here in a very brief way without going into a lot of detail, but give you enough so that you can understand what's going on. But after this first screen, once we understand what cash flow additivity is doing, if you want to just say, you know what, I'll wait and I'll see it when I see it, then you won't be missing anything. You may be missing something here. The end of chapter questions may be hard to answer. The in-text examples may be difficult, but after you've done fixed income economics and derivatives, if you come back to these, you go, oh, these are easy. So let's talk about what cash flow additivity is, because it forms the basis of something called the principle of no arbitrage. And the principle of no arbitrage says two economically equivalent strategies should have the same price. And this is how we price out derivatives. So if you were wondering, how do we arrive at a futures price for a stock index? It's arrived at through the principle of no arbitrage, because we could simply borrow money, buy the stock index, sell the stock index in the future and pay back the borrowed funds. That should be economically equivalent to buying a futures contract on the exchange. The payoff should be, the price of the futures contract should represent a no arbitrage price based on what we could do to derive the same set of cash flows. So usually when we see a calculation for or a formula for a derivatives contract, the statement is written such that both cash flows net out. This cash flow minus this cash flow would equal the futures price. Well, that's cash flow additivity. So let's lead into it nice and slow. Let's say that we have option A, which has these cash flows, 3 cash flows of $45. We have option B, which has a 60, 40, and 32.50. Which one do you want? Well, an easy way to do this is just to calculate the present value of both and compare them, right? Is there a way to do it in one step? There is. We can just take the difference of those cash flows and just calculate the present value of the difference of the cash flows. So we're going to take A minus B. And if the present value of A minus B is 0, clearly A must be greater than B. We'll choose A. If it's less than 0, we'll choose B. So A minus B is negative 15, 5, and 12.50. If you calculate the present value of this stream of cash flows with a discount rate of 6%, you'll find that both are equivalent. Since both are equivalent, the present value of both are equivalent, they should trade at the same price. What if they don't? Let's assume for a moment that A is selling at $50, B is selling at $60. We know the present value of their cash flows are identical. So we have an arbitrage opportunity, and we follow the tried and true rule of the market, buy low, sell high. So we will buy A and we will sell B. Let's go up to the timeline and see what happens. Now, we received $60, we paid $50. So we've made $10. And we have a risk-free position at this point. Let's move to the first cash flow. We get 45 in because we're long, but we have to pay 60. So we give the 45 to the other side and we borrow $15 at 6%. The next period, we get 45 in. We owe 40. We have $5, so we can reduce our loan by $5 at this point. The next period, we get 45 in. We pay the $32.50. The difference should completely pay off the loan. So there, we haven't lost or made anything in the cash flows, but we made $10 up front. So I'll do that all day long. I'll buy A and I'll sell B until the prices move together, because buying will push the price of A up, selling will push the price of B down until that opportunity disappears. Just to see that we can just take the difference, just so that you're comfortable in taking the difference. Let's start with an example where obviously one is superior, and we'll see that no matter which way we do it, it works out. So let's say we have 2 cash flows, A and B. Our required return is 6%. A pays 100, B pays 120. Clearly B is superior. You would take B because it pays 120. Well, take the difference, you get negative 20. Discount negative 20 by 1.06, you get negative 18.8679. If you took the present value of A on its own, then the present value of B on its own and subtract them, you get the same thing. I'm doing that just to give you comfort that you can just add or subtract cash flows and find the present value of that and come up with the same answer than if you had done the present value of all the separate cash flows. This is very useful when you're comparing like 8 different types of cash flows, where you say, well, what if I went long these 3 and short those 5? You can just simply add those 3 cash flows, subtract the other 5 cash flows into one stream of cash flows, and find a present value on that. Okay, let's look at implied forward rates. And it is written as F11. How do we read that? It's written as F for a forward rate. The first term is when, the second term is what. So it's a when what term. It's a forward rate. When in 1 year. For what? 1 year. So F34 is a forward rate that begins in 3 years that lasts for 4 years. I do explain that when we get to fixed income. These rates, these forward rates, are traded in the market. You can enter into something called a forward rate agreement to lock in an interest rate at some point in the future. And because you can do that, well, it has to be a rate that provides no arbitrage. So look at the problem we have here. We have a decision to make. We observe a 2-year rate at 3.5%, and we observe a 1-year rate at 2.5%. What should be the no arbitrage price of the forward rate agreement? Because we can invest in 2 years by buying the 2-year zero coupon bond. Or we could buy a 1-year zero coupon bond and buy another one in 1 year, or enter into a forward rate agreement and lock in that forward rate. Well, both should provide the same outcome. In other words, investing for 2 years at 3.5% should be equivalent to investing at 2.5 and then rolling over into the forward rate. If the forward rate were priced any differently, there'd be an arbitrage opportunity, and buying and selling would come in until that opportunity disappeared. So there would be just one price on that forward rate agreement. Well, 1.035, we're going to invest in 2 years, should equal, we'll invest at 2.5% for 1 year and roll it over into the forward rate. This is what we're solving for, a little bit of algebra, and you'll get to 4.5097%. Let's create an arbitrage opportunity. Let's make the forward rate 5%. What can we do? We can lock in that rate with a forward rate agreement. How would we do it? Remember the rule, buy low, sell high. Is 5% higher or lower than 4.5? It is higher, so we would sell the rate. Why would we sell the rate? Let's say that the rate falls to 4% by the time we're ready to accept that interest rate. Well, because we were short, we make all the money from 5% to 4% on some notional amount of money. However, in the market, we can only get 4% now, right? So our money in the market can only get 4%, not the 5%, but since we were short at 5%, we made all the money from 5% down to 4%, thereby getting us our 5%. So we can lock in the rate with an FRA. We'll invest at 1 year at 1.025, and we locked in 5%. Our future value there is 1.07625 per dollar. If we took the 3.5, we'd have 1.071225 per dollar, basically half a penny more. And if you quote it per 100 of par, we'd provide an arbitrage profit of 50 cents per 100 of par. Well, that's free money. It's risk-free money. So you would do that until the arbitrage opportunity disappeared. Let's have a look at a problem here, and let's solve some implied forward rates. Let's say on May 31st, we observed a 1-year zero coupon bond trading for 98.028 and a 2-year zero coupon bond trading for 95.109. 15 days later, the 1 year is at 97.402, interest rates went up, and the 2 year is now at 93.937. What was the change in the implied forward rate? So we're going to need an implied forward rate from the 1 year to the 2 year for May 31st, and we're going to need an implied forward rate from the 1 year to the 2 year for June 15th. We're only given prices. We can solve it from prices, by the way. It's quite simple to solve it from prices. But what we'll do is we'll figure out, well, what was the implied yield to maturity on each of these two securities, and then we can calculate the forward rate. So we need a 1 year rate. Well, that's easy. 100 divided by 98.028. What are we doing here? This is the future value divided by the present value. And since it's only for one period, we don't have to worry about a power term. Subtract the 1. That means the implied yield to maturity on this is 2.011%. For the 2 year, it is future value over present value, but since it's for 2 years, remember it's to the power of 1 over t. 1 over 2 minus 1, we get 2.539. Now we're in a position to calculate that forward rate. The longer term security over the shorter term security. So you always put the longer term security, so the 2 year will go in the numerator. And remember, since it's 2 years, you're squaring the return. Divided by 1.02011, the 1 year minus 1. The implied forward rate is 3.069. That is as of May 31st. I have to go to the next screen and keep this going. Okay, so we had calculated the forward rate at 3.069%. We do the same for the 1 year and the 2 year as of June 15th. For the 1 year, it's the future value over the present value. Subtract the 1, you get an interest rate. For the 2 year, the future value of the present value, 1 over t, which is 2, minus 1, 3.167. The longer rate goes in the numerator. divide through 3.6886. And we were asked, what is the difference in the forward rate? Well, it is now 3.6886. It was 3.069. The forward rate increased by roughly 62 basis points. Another way to do this, instead of taking the prices to extract the rates, we can just use the prices directly. This, by the way, is called the forward rate model. I'm about to show you the forward pricing model. All stuff you're going to see in fixed income. This requires just a little bit of thinking. In 1 year, what is a 2-year bond going to be? In 1 year, a 2-year bond will be a 1-year bond. Well, there's the price of the 1-year bond, right? So for the 2-year bond, what is the future value in 1 year? It's the price of the 1 year. So future over present, 3.069. Do it again for June 15th. The future value over the present value, 3.688. 3.069, 3.688. What do you have up here? 3.688, 3.069. Notice that if you subtract the two, you get the same thing. So you didn't have to extract the rates, then use the forward rate agreement to get the forward rate. You could have just used the prices directly to get the implied forward rate. If you use these prices directly, you'll get the implied forward rates and subtract the two. I'm throwing a lot of stuff out at you. This is stuff you're seeing really early in the curriculum. I want to stress again, you see all of this stuff later on. Putting it here just sort of gives you an idea of the arithmetic involved and maybe some of the terminology, but I find that it can be overwhelmingly confusing, especially if you haven't seen this stuff before. You might say, but I need more explanation. I'm not shortchanging you here. You're going to see it a lot more later on, which is why earlier in this learning objective I said, if you want to walk away from this when you can, you won't lose anything because you see exactly everything again in the future with much longer and deeper explanations than I'm giving you here. Let's go into Forex, into the currency markets, and calculate a forward exchange rate, which is if you're trading futures on any currency pair, this is the quoted price you would see is the forward price or the futures price. And this just requires some logic to understand the formula because the formula is down here. Well, how do we get to there? Remember, there must be no arbitrage price. So what can we do if we have $1,000 US? Well, we can invest that $1,000 US at whatever the domestic rate happens to be, RD. Or we can use the exchange rate to convert this $1,000 into a different currency. This over here is now a different currency, and we can invest it at the foreign rate for that period of time. Those two cash flows, combined with some forward rate in the future, must be identical. So if we take our $1,000 and say, okay, now let's convert it to the foreign currency, we should get the same amount as if we had converted the currency today and got that interest rate. We should get the same amount. That's how we determine what the forward rate is. So it is the just a little bit of math, and you can get this ending equation here, the spot rate. And notice it's of the form foreign over domestic. It has to be of the form foreign over domestic. Look at your numerator. You have the foreign rate in your numerator, and in your denominator, you have the domestic rate. F over D, F over D. It is the spot rate multiplied by the ratio of the two. You will sometimes see it written this way, 1 plus R days over 360. This would be the foreign rate up here, 1 plus R days over 60. This would be the domestic rate down here. Let me take this opportunity to clear up a conceptual error that you are finding in the CFA curriculum. While the calculations are correct, and the math and the algebra is correct, the error comes in the type of interest rate that they're using. For a forward rate agreement, for forward exchange rates, and for options, the three things that we're doing in this learning objective, you would not use government spot rates. You wouldn't use government spot rates to calculate the implied forward rate. Reason is very simple. Only a government can borrow and lend at the government rates. Everyone else uses an interbank rate. So typically, all derivatives used to be priced out by an interest rate called LIBOR. So we should be using LIBOR rates here and LIBOR rates here. Well, LIBOR is being phased out and being replaced with something called SOFR, the Secured Overnight Funding Rate, just shortened as SOFR. So you'll use SOFR rates. These are interbank rates. I want to be clear on this. Conceptually, you would never use the government curve and the rates from the government curve to price out derivatives, because the government is not in the derivatives market. The investment banks are. They're typically the counterparty to almost all derivative contracts when you get to OTC. So you're using, OTC meaning over the counter, you're using an interbank rate to get it done. You're using SOFR rates, not government par rates. Other than that, everything else is correct. The process we went through is correct. The math is correct. The calculations are correct. The formulas are correct, except you're using a interbank rate, not a government spot rate. Okay, let's play around with some numbers here. Let's calculate a 6-month forward rate on the yen-US pair. And I'll give you some look ahead here. When a currency quote is used in the CFA curriculum, it's not a market quote. So if you look at it and you say, but that's backwards than what the market has, yeah. The CFAI uses fractions. They quote the exchange rate as a fraction with the denominator always equal to 1. So when we see S, and the sub is yen US, that we know we're dealing with a spot rate, a spot exchange rate. It is of the form price over base, always of the form price over base. The base always equals 1. What does this mean? $1 buys 134.4 yen. So basically, the fraction is 134.4 over 1, which has to equal 134.4. The base will always be 1. The numerator is the price currency. So what we're asking is, what is the price of the base? The price of $1. Well, the price currency being yen, the price is 134.4. You give me 134.4 yen, I'll give you a US dollar. It's the same thing as saying, you give me $1.50, I'll give you a Diet Coke, right? We observe an interest rate in the US of 2%, in Japan 0.05%, and we want a 6-month forward. So it's simple enough. We take our spot rate and multiply it by the ratio of the two interest rates. Since our yen is in the numerator, our numerator will be the yen rate. Our US is in the denominator. The denominator here will be the US rate. This is just plug and play, right? 133.0959. Well, let's talk about a relationship that you will notice here. When the interest rate in the numerator is lower than the interest rate in the denominator, the forward will be at a discount to the spot. We say the forward is trading at a discount to the spot. If it were the other way around and let's say that the interest rate in Japan was higher than the interest rate in the US, the forward would be trading at a premium to the spot. This is stuff I go into when you get to the currency reading in economics. So if your mind says, wait, what was that again? Don't worry about it. That's really not the point of this learning objective. The point was to show you all the applications of the time value of money. And when you price out derivatives, as I explained in the derivative section, if you conceive of all derivative problems as time value of money problems, they become super easy to solve. Let's take an example here. May 31st and June 15th, we observe some interest rates. RF is 2.012, RD is 1.291. That means the foreign interest rate on May 31st is 2.012. The domestic interest rate is 1.291. Here we're going to calculate a forward rate, and it is always of the form F over D, foreign over domestic. Whenever you're calculating foreign forward rates, it's foreign over domestic. Let's say that I'm in Canada and I'm looking at the US dollar and the Mexican peso. That's interesting, isn't it? Which one is my domestic currency? Neither one of them. For me, they are both foreign currency. So how would I handle this particular problem? The domestic currency would be the currency in which you would want any foreign currency translated into. So after I'm done with the US-Mexican trade, I have to ask myself, do I want to end up with US dollars or with pesos? If I want to end up with US dollars, there is D. Simple as that. We have our foreign and our domestic interest rates for both May 31st and June 15th. We want to calculate what is the difference in how did the forward rate change, the 1-year forward rate change, assuming a spot rate of 1.2602. So it's the spot multiplied by the ratio, F over D. So there's the foreign, there's the domestic. Notice it's E to the RT, but here we're saying 1 year, so T just equals 1. That's why it's just E to the R. 1.26, use the other rates in the same ratio, 1.27. What is the difference? 0.004883 or 48.83 pips. You go out, you move the decimal place over 4 points and put a decimal place, and these are called pips. When you're dealing with currencies, those are called pips. When you're dealing with interest rates, those are called basis points. Let's move over to option pricing. And here, I don't quite agree with the placement of the binomial model this early in the curriculum, because it can be confusing. I do explain this in derivatives in a lot of detail, nice and slow, but if you're reading through the content and you get to this point, you're probably, if you've not seen the binomial options pricing model, you're probably looking at it and saying, I don't understand what's going on. Because they're just assuming the hedge ratio. They're saying, assume that you buy this many shares of something without explaining, well, how do you get a hedge ratio and what is it that you're trying to do? What we want to do is price out a call option. But to do that, we're going to have to set up something such that we have a risk-free outcome in which we can then price the call option. So we have a stock, S, forget the H for now. Just say that we're going to buy this stock and we're going to sell a call option on this stock. And the stock can either go up or the stock can go down. If it goes up, we'll call it S plus, and we'll call the option, the call, C plus. C meaning, well, the price went up. If the price goes down, we'll just call it S minus, and we'll call the option C minus. And we know we're not buying a full share. We're going to buy some fraction of a share. Just because I'll explain the hedge ratio over here. We'll buy some fraction of a share. So if it goes up, we'll have HS plus and the option is C plus. There we go. What we want to do is select H to find an H such that the outcome up here is equal to the outcome down here, so that we have the same result no matter what. Once you have that, well, remember the cash flow additivity principle. If two cash flows are the same, they should have the same price. We should be able to equate the final amount with the beginning amount. Since the beginning amount has C, which is the unknown, we should be able to solve for C. Let's first of all figure out what the hedge ratio should be. We're saying that these two outcomes should be equal, so let's make them equal. Remember, we're short the call, so that's why we subtract it. We will have H shares of S, but H shares of S plus minus the C plus should equal H shares of S minus minus the C minus. These two should be equal. Well, let's calculate all the shares to one side, all the calls to the other side. We'll have HS plus minus HS minus equals C plus minus C minus. Well, we have a common term, H. Let's take that out. We have S plus minus S minus equals C plus minus C minus. Divide through by the S plus minus S minus. Your hedge ratio is C plus minus C minus over S plus minus S minus. That'll tell you what this should be. Once we know what that should be, we can calculate in dollar value what the outcome is here. We know how much the share was to begin with. We know how many shares we have. Our only missing variable is C. Since this is a price in the future, we can discount that to today and solve for C. That's all we're doing. Let's go through some numbers to show you what it looks like. Okay, we'll walk through two examples. At the very top of the screen, we'll do the call, and over here, we will calculate the price of a put using the same process. But before we begin, let me just draw a timeline. And let's say that we observe some dollar amount over here, and let's say we observe some dollar amount over here. Can we compare those two dollar amounts? No, we can't, because they happen at different times on the timeline. We can either move this one forward and compare the two numbers here, or move this back and compare the two numbers here. That's what we'll be doing down here. Notice 1 plus R, we're discounting it back 1 period, is because the payoff up here is 1 period from now, and we want to compare it with the original cost. We have to discount it back. So let's begin. Let's say that we observe a stock selling for $40. And we're going to sell a call on that one because we want to price out the call. The call will have a strike price of $50, which means if it's above $50, the call will have value. If it's below $50, the call will have no value. And our interbank risk-free rate is 5%. We're going to make the assumption that if the stock goes up, it'll be 1.4 times what it was. In other words, it'll go up by 40%. I have U equals and D equals. You don't need U and D right now, but when we get to the binomial option pricing model, you will need to use U and D to calculate something called risk-free probabilities. Don't worry about that right now. I'm just giving you sort of what the roadmap ahead looks like. Don't worry too much about it. So if it goes up from 40, it goes up 40%. On an up move, it'll go to $56. Well, what's the call worth? Well, if we have a strike price of 50, the stock is 56, the call has a value of $6. If the stock goes down, it'll go down by 20%. In other words, D equals 0.8. 0.8 times 40 is 32. 20% of 40 is $8. 32, it's the same thing, right? Well, the call's worth nothing because the strike price is 50. Anything below 50, it's worth nothing. Now we're ready to calculate what H should be because we need H. H is going to be C plus minus C minus over S plus minus S minus. We get to 0.25, so we know our H is going to be 0.25. Let's make sure that whether the stock price goes up or down, we end up with the same amount. H, S plus minus C plus, minus because we're short the call, 0.25 shares at $56 because that's what it amounted to, minus the $6 because we're short the call, we walk away with $8. If the price went down, we have 0.25 shares that are only worth $32, but the call is worth 0, that is $8. Notice that it's identical. Therefore, our starting portfolio, buying a quarter of a share and selling a call with a strike of 50, is a risk-free portfolio because no matter if it goes up or down, we have the same payoff. And because we have the same payoff, we only have to use one of the outcomes. So we'll use the upper outcome over here. Here's our beginning portfolio. Here, the numerator is the value of the portfolio 1 period from now. Remember, this timeline up here, we can't compare those two numbers, so we have to discount this by 1 plus R to compare it with here so that we can solve for C. So our beginning portfolio is 25, or 0.25 shares at $40 minus the call. There's what we're trying to solve. We know the outcome. We're going to have a quarter of a share at $56 minus 6. That's our payoff. We know that is 8, and we'll discount it back at 1.05. So we know 0.25 times 40 is 10. So we have 10 minus C naught equals 8 over 1.05. So let's just rearrange terms. You'll have C naught equals 10 minus 8 over 1.05. You calculate the price of the call. That is a 1 period binomial options pricing model. Is this used? Sometimes it is. Let's say that you have a piece of land. And you want to sell that piece of land, but that land is unserviced and has had no survey done on it. And I think, well, what if I can't get the environmental survey done so that I can build on that land? I'm a builder. Well, then the land is not worth anything to me. It's only worth what the land is worth without having the potential for development. But what if it passes all the environmental inspections and I can build on the land? Well, then the land is worth more. So I can go to the seller and I can say, let me buy a call option on this land because it will have two outcomes. Either it will pass the surveys and be worth $5 million, or it will not pass the surveys and be worth $1 million. And you're asking $3.5 million today. Well, I know what my up is. I know what my down is. I may buy a call option for $3.5 million. Now I know how to price the call option on the land. And let's say I want a 3-month call option because it's going to take me 3 months to get all the environmental surveys done. And if the environmental surveys don't work out, thank God I didn't spend $3.5 million for something that's only worth $1 million. You get that? Even if it cost me $200,000 to get all that done, it's a lot better than losing $2.5 million because it couldn't get done. If it cost me $200,000, well, the land is now worth $5 million, and I have a call option at 3.5, so I'm all in, I'm 3.7. So that's where the value of the option is that why would I spend money on something only to find out it can't do what I want? Why not option it first? Other places where you have options, movie theaters or movie studios sometimes will approach a novelist and say, can we option your book for a screenplay? And they'll pay the novelist maybe $10,000 for a period of 3 months while they send that book around to their writers to say, what do you think? Is there a screenplay in here? Can we make this into a movie? And if they can, well, then they have a call option on the rights to the novel. If not, then they let it go. So there are instances where you would use a one-period binomial options pricing model when the outcomes can be fairly predicted. Okay, let's look at a put. For the put, whatever we do for a call, we do the opposite for a put. So if we sell a call, we're going to buy a put. So 40 plus a long put. Long stock, long put. Strike price of 50, same thing on the interbank interest rate, 5%. How the put works is we have a strike price of 50. If the stock is above 50, the put is worthless because you wouldn't put it to somebody for $50 if you can sell it in the market for more. Anything under 50, the put has value. So if the price goes to 56, the put has no value. If the price goes to 32, well, we can sell it to somebody for 50 because we have a put. The put is worth $18. Calculate your hedge ratio, C plus, in this case, it would be P plus minus P minus. And we're looking at the absolute value here because our hedge ratio is always something positive. 0 minus 18 or 50, 6 minus 32 will give you 0.75. So we know we're going to use 0.75 shares. So 0.75 of 40 is 30. Here is the P. This is what we're trying to solve. There is the value of the portfolio in one period, and we must discount it back to compare it with our original cost. Well, P is the only unknown over here. Do a little bit of rearranging. You'll get P equals 10. Now, if all of this was a little confusing and you looked at it saying, I'm just not seeing it, don't worry. For forward rate agreements, you will see them again in more detail. For forward exchange rates, you will see them again in more detail. And for the options pricing model, you again will see it in more detail. Hopefully, when you do see it, being that we've laid some of the groundwork for the conceptual ideas behind the arithmetic, the ideas behind the math, then you could start worrying about the methodology of the forward rate agreement, the options pricing model, the forward exchange rate, etc., without having to worry about all the arithmetic. And that's it.